The silence is over. The signal has been sent, and it didn't come from London or New York. It came from the East, and it came with the force of a tectonic shift. I am your host, and you are watching Analysis with AG, and today we are witnessing the moment the global silver market fundamentally broke. This is not a drill. This is not a speculative what-if scenario. This is not a speculative what-if scenario. This is mathematics. This is raw, undeniable data manifesting in real time. While the Western financial media was distracted by headlines that don't matter, the Shanghai Futures Exchange, the largest physical metals exchange in Asia, just exploded. Silver didn't just move, it gapped. It opened with a 13% surge, hitting 22,634 yuan per kilo. When you run the conversion, when you strip away the currency layers and look at the raw value in US dollars, you are looking at silver trading above $102 per ounce. Let that number sink into your consciousness. $102.88. The threshold has been crossed. The psychological barrier that the algorithm has spent decades trying to protect has been shattered in a single session. I told you this was coming. If you watched my analysis last night, you know I was watching the Shanghai open like a hawk. I told you that if it opened above 95, the game was over. It didn't just hit 95. It treated $100 like it wasn't even there. I was sitting at my desk, refreshing the charts every 30 seconds, watching the world change. When that $102 print hit, I had to take a moment. For months we have tracked the inventory logs. We have watched the COMEX bleed. We have tracked the recycler prices in China. There were moments of doubt when the paper markets slammed the price down, but today, every doubt has been erased. This is the great divorce between the paper promise and the physical reality. To understand why this happened today, you have to understand the pressure cooker that was built over the last week. For 7 straight days, the Shanghai Futures Exchange was dark. The Chinese New Year shut down the biggest physical hub in Asia. For an entire week, Chinese traders were locked out. They were forced to sit on the sidelines and watch. They watched silver move internationally from the low 80s to nearly 90. They watched the trade war with the West escalate. They watched the European Union freeze major trade deals. Most importantly, they watched their own domestic recyclers start paying $96 an ounce for scrap metal because they couldn't get the refined bars. The spring was coiled to the breaking point. When the doors finally opened this morning, the demand didn't just flow, it erupted. A 13% move in a single session on a major exchange is not normal market behavior. It is a structural failure of the current pricing mechanism. It is a market screaming that the current international spot price is a lie. This is the hidden economy revealing itself, and the algorithm wants to bury this. They want you focused on the $88 paper price in New York while the physical world is already paying triple digits. If you are new here, you need to understand that we don't follow the narrative, we follow the data. Hit subscribe and help us blow this up, because the truth teller persona isn't just a style, it's a necessity when the system is this broken. Smash that hype button. We need to beat the algorithm that is trying to keep this $14 gap a secret. Let's talk about that gap, the arbitrage. This is where the math gets dangerous for the Western vaults. Right now, there is a $14 difference between what you can buy silver for in London and what you can sell it for in Shanghai. In the world of high finance commodities, a 14% premium is not just a spread, it is a gravitational pull. Think about the physics of this. If you are a repriner, a bullion dealer, or a hedge fund with physical delivery rights, what do? You don't sell to the COMEX at 88. You don't sell to London at 88. You pack every ounce you own onto a plane and you ship it to Shanghai. This premium acts like a massive vacuum. It is sucking the remaining lifeblood out of the Western vaults. Every available ounce of free-float silver on the planet is now being diverted east. This is why the premiums inside China have been rising for months. Their government restricted exports in January because they realized silver is a strategic asset. They are locking the doors from the inside, and now they are outbidding the rest of the world to bring more in. A structural crack like this doesn't just heal, it widens until the entire system snaps to the new reality. I spoke with a veteran metals trader recently who told me that once a premium hits 10%, the contractual loyalty of the market vanishes. Nobody cares about their long-term supply agreements with Western manufacturers when they can make an instant $14 per ounce profit by diverting the shipment. This is the arbitrage that breaks the COMEX. Now, look at the most insane piece of data I have found in 20 years. This is the part that should make your hair stand on end. While the physical price is hitting $102, the managed money, the speculators, the hedge funds, the smart money is nowhere to be found. The current long position for managed money and calm silver is at 12,121 contracts. To put that in perspective, that is the lowest level in 2 decades. Go back to 2006. Silver was trading at $11 an ounce. In 2006, there were more people betting on silver going up at $11 than there are today at $88. Let that sink in. The speculators are not in this trade. The massive move we have seen, the rally from $30 up to $121, the crash to $77, and the rebound to $88 has happened with zero speculative participation. This move has been driven entirely by industrial necessity, central bank accumulation, and physical desperation. The hot money hasn't even arrived at the party yet. The momentum chasers, the CTAs who buy breakouts, the retail crowd that piles in when a ticker trends on social media, they are all still on the sidelines. They are waiting for the algorithm to give them a buy signal. But the algorithm is calibrated to the paper price. What happens when the international spot price finally catches up to Shanghai and every Bloomberg terminal on the planet flashes silver crosses $100? When that happens, the 12,000 contracts of managed money longs will try to become 50,000 or 100,000 contracts overnight. In 2011, when silver ran to $49, we saw nearly 100,000 long contracts. If the specs try to pile back in now, they will be looking for nearly 440 million ounces of silver in a market that is already in a physical deficit. The math is simple. 100,000 contracts equals the entire COMEX inventory. There isn't enough silver in the world to satisfy the paper demand that is about to hit. When the specs show up, we aren't going to see a rally. We are going to see a detonation. And who is on the other side? Who is brave enough to short this? Look at the iShares Silver Trust, the SLV. Right now, there are 10 million shares available to borrow for short sellers. The fee to borrow those shares is a measly 0.55%. It is essentially free to bet against silver right now, and yet the data shows the shorts are folding. The availability of shares is high because nobody wants them. The smart shorts looked at the Shanghai tape this morning and realized they were standing in front of a freight train. They are covering their positions and getting out of the way. If you are still shorting silver in this environment, you aren't trading, you're gambling against a mathematical certainty. The real crisis is brewing in the COMEX March delivery month. We are just 3 trading days away from the first notice day. As of the latest report, the open interest for March stands at 44,522 contracts. That represents 223 million ounces of silver exposure. Even if 70% of those people roll their contracts to May, we are still looking at a potential delivery demand of 67 million ounces. Can the COMEX handle 67 million ounces of delivery in a single month? The answer is buried in the vault reports. On Friday alone, the COMEX warehouses lost 2.25 million ounces. This wasn't just one vault, it was a synchronized drain. JP Morgan's vault lost nearly 1 million ounces in 24 hours. HSBC lost 637,000. The Delaware Depository lost 500,000. When you see 4 major vaults all bleeding in the same direction on the same day, it's not a coincidence. It's an exodus. Let's focus on JP Morgan for a moment. This is the bank that took delivery of 8.1 million ounces in January. They were the biggest buyer. They took the metal, put it in their COMEX vault, and now, just weeks later, they are moving it out. Where is it going? It's leaving the system. It's going into private storage, or it's being prepped for shipment to where the price is highest. When metal leaves the COMEX vault system, it doesn't come back. Not when the physical market is paying a $14 premium. If March deliveries match what we saw in January, the registered inventory of the silver, actually available for sale, could drop below 330 million ounces by the middle of next month. That is a danger zone we haven't seen in years. At some point, the number of paper claims will so far outweigh the physical bars that the exchange will have to move to force majeure or cash settlements. And that is the day the paper market dies. Shanghai just proved that the physical market is ready to take the wheel. Consider the $70,000 arbitrage. If you are a trader holding a March COMEX contract, you have a choice to make in the next 72 hours. You can roll that contract to May and keep playing the paper game. Or you can stand for a delivery. You can take your 5,000 ounces of silver at the COMEX price of $88. You can then immediately turn around and sell that silver into the Asian market for $102. That is a $14 profit per ounce. On one single contract, that is a $70,000 profit. How many hedge fund managers are waking up today, looking at that $70,000 per contract free money trade and calling their brokers? This is how a delivery squeeze starts. It's not about silver bugs or stackers. It's about cold, hard arbitrage. The gap between Shanghai and New York is a dinner bell for every predator in the financial world. They are going to feast on the COMEX inventory until there is nothing left but dust and empty ledgers. This changes the entire narrative. For 50 years, the world has been told that silver is a byproduct, a secondary metal, a poor man's gold. The financial media has treated it like a relic of a bygone era. But look at what is happening on the ground. This isn't your grandmother's silver spoons. This is the most essential industrial metal of the green energy transition. Solar panel manufacturers are in a state of panic. They don't have a choice. They can't wait for a dip. They have production lines to run and government mandates to fulfill. They are the ones bidding silver up to $102 in Shanghai. They are competing for a shrinking pool of metal. This is price inelastic demand. Whether silver is $30 or $300, the solar industry has to buy it. And they aren't the only ones. Samsung and other tech giants are quietly locking up entire mine outputs for years in advance. The silver coming out of the ground today was sold 3 years ago. The free float that you and I buy is a tiny fraction of the total market, and it is disappearing. For the miners, this should be a golden age. But they can't save us. You can't just flip a switch and get more silver. It takes 7 to 10 years to bring a new mine online. The supply response is years away, but the demand spike is happening this morning. This is the perfect storm. I know the critics will say I'm being too bullish. They'll say I'm ignoring the risks. So let's talk about them. Could the price pull back? Of course. We saw it drop $40 in a week last month. The paper markets are violent. They will use every tool in their arsenal: margin hikes, limit down rules, media disinformation to try and scare you out of your position. They want you to see the volatility and run. But you have to ask yourself, did the physical shortage go away during that $40 drop? No. It got worse because people bought the dip. Pullbacks in this environment are not exits. They are gifts. The fundamentals are not just strong. They are accelerating. Every day that Shanghai stays above $100 while New York stays at $88 is another day that the Western vaults are emptied. There is no other resolution to this gap. Either the Chinese price has to collapse, which isn't happening because of industrial demand, or the international price has to move up to meet it. The algorithm is currently fighting a war it cannot win. It is trying to suppress the price of a physical commodity that is in a global deficit. It's like trying to hold a beach ball underwater. The deeper you push it, the more violently it will eventually break the surface. We are at the point where the arm of the suppressor is getting tired. Look at the transition that is about to happen. We are moving from a quiet market to a mania market. We have seen this movie before. In 2011, the move from $20 to $50 happened in a blink. But that move was driven by speculators. This move is being driven by the physical reality of 102 silver in Asia. When the speculators finally do arrive, and they will be piling onto a fire that is already raging. Imagine 300 million ounces of new paper demand hitting a market where the vaults are already draining at a rate of 2 million ounces a day. You don't get a rally in that scenario. You get a vertical line. You get a price gap that leaves everyone behind. Shanghai opened today and sent a message to the world: the crash was a lie. The paper price is a fiction. Silver is a triple-digit asset, and the rest of the world is just starting to wake up to that fact. We are going to look back at this Monday as the day the Great Divorce became official. The day the East decided it would no longer let the West set the price for a metal it doesn't actually possess. Tomorrow, I am going to take this even deeper. I have been digging into the why behind China's moves. It's not just about silver, it's about a massive shift in their foreign exchange reserves. They are dumping US treasuries and piling into physical assets. I found evidence that involves Tencent, Alibaba, and a strategic plan to dominate the silver-backed technologies of the next decade. There are even whispers of a geopolitical struggle over the world's largest silver deposits in Mexico. It is a financial world war, and silver is the primary ammunition. You did not want to miss tomorrow's video. It is quite possibly the most important piece of research I've ever compiled for this channel. Make sure you are subscribed. Make sure your notifications are on. This story is moving faster than the media can keep up with, and we are going to stay on the front lines. Drop a comment below. I want to know, did you see the Shanghai number this morning? Did you believe it? Or did you think it was a glitch? How are you positioned for the COMEX March delivery? I read every comment, and your input helps us beat the algorithm and get this truth to more people. If you haven't seen my video from last night where I predicted this exact gap, go watch it now. The link is in the description. Everything I laid out in that video was confirmed the moment the Shanghai Exchange opened. The framework is holding, the math is working. Share this video. Send it to your friends who think silver is dead. Send it to the people who told you that $30 was the ceiling. Show them the $102 print from Shanghai. This is the hidden economy. The doors are locking, the vaults are emptying, and the algorithm is losing its grip. Stay sharp, stay disciplined, and most importantly, stay stacking. The physical reality is finally here. I'm your host, and this has been Analysis with AG. I will see you tomorrow for the biggest story yet.